Charity accounts for non-accountants.
Hello everyone, I'm Shachi Blakemore. I'm a partner in the charity and not-for-profit team at Buzzercott, and today I will be presenting on accounts for non-accountants. In the section that I'm about to present, I will be covering the statutory reporting requirements for charities' financial results and position, drawing out certain key aspects of reporting and why financial information needs to be presented in a certain way, but also really underlying bases on which the accounts are prepared. Hopefully with a view that you can understand the charity's financial statements better, but you're also able to ask certain key questions when faced with your charity's accounts. The first thing to be aware of is that there's a statutory requirement in relation to your charity's accounts. They need to be based on the Charities SORP, the Statement of Recommended Practice as issued by the Charity Commission, the charities regulator in England and Wales. It is essentially a set of detailed guidance on how to report the charity's financial performance and position, applying UK legislation such as company law, charity law, but also the accounting rules, which currently we're reporting under the FRS 102 accounting framework. However, the first thing to be aware of is that the recommended in the Statement of Recommended Practice is a bit of a misnomer. Charities don't really have that much of a choice in the matter. With charity registration, you obviously get the benefits of being a charity, and at the same time there are the expectations that go with that charitable status. And along with that, you have to accept that there are certain compliance requirements that your charity needs to meet. In fact, you're required rather than recommended to comply with the SORP requirements in order so that your charity's accounts, charity's financial statements, give a true and fair view of the activities. It's worth being aware, however, that there are specific statements of recommended practice for certain groups of charities, such as further education colleges, higher education institutes, housing associations. So you may well be a charity that falls in that bracket. But otherwise, for most charities, it's the Charities SORP that will be applicable. The only exception to the reporting requirements are if your charity is very small. If your charity is unincorporated, has income below £250,000, and therefore it can prepare accounts on a cash basis, you have the exemption of not necessarily having to follow the full SORP requirements, but rather simple reporting of your charity's income and expenditure. It is also worth considering at this point other compliance requirements in relation to your charity's accounts, which is, do your accounts need to be audited or not? If your charity has income of more than £1 million, by law you are required to have an audit. Likewise, if you're a charity that is asset rich, so for example, you have assets of certainly 3.26 million and more, but your income is fairly low, so your income is around the sort of £250,000 mark, you still need an audit. Charities with income between 25k and 1 million can opt to have an independent examination. An independent examination is far less onerous and therefore a lot less expensive than a full audit. But of course, it also doesn't have the same rigour. And before you opt to have an independent examination, there's two key things to bear in mind. It's worth checking either your charity's trust deed or the memorandum and articles of the charity to see if you have that exemption available. In some cases, charities need to have audited accounts irrespective of size. And the other is having a much more commercial awareness. There is an expectation amongst some funders that actually they would prefer the charity to have an audit if they're going to provide funds to it. So this is also a consideration before you decide if you have an audit or opt for an independent examination. Moving on to the contents of the charity accounts, what is it that you would expect typically to see in a set of charity accounts? The first is reference and administrative information. And this is typically 1 or 2 summarised pages, which will include names of trustees, senior management, details of your bankers, your investment managers, your address, and so on. Then you have the trustees report, which will include in essence, the reporting of your charity's activities in the year, but also certain background information such as structure and governance and so on. This element will be covered in more detail in the later part of this training. After the trustees report, you have the auditor's report or an independent examiner's report. And the key thing here is to be aware of what the opinion is. A clean audit opinion is essentially the auditor agreeing that the accounts show a true and fair view. Then you have the Statement of Financial Activities, or as it's commonly known, the SOFA. It is in essence the income and expenditure statement for the charity. After the income and expenditure statement, you have the balance sheet, and the balance sheet really is a snapshot. It summarises where you are in terms of your funds, your reserves, your assets and liabilities as at your year-end date. And then followed by that, for some charities, although not all, there will be a cash flow statement. What a cash flow statement is, it's essentially a summary of where the charity's cash or monies in the bank have been spent in the year. And therefore, it's looking at the movement in the year on a cash-only basis. This requirement is only there for charities that have income of more than £500,000. So if your charity is smaller than that, you would not expect to see this typically in your accounts. You also have accounting policies. The accounting policies is usually 2 or 3 pages long, and it's summarised stating how each key area within the financial statements has been treated. What is the basis on which the accounts have been prepared? Later on, I will talk about 2 key bases which are really important for a charity reader to be aware of. And then the final segment is what's called the notes to the accounts. And these are really more detailed financial information that you've seen in your balance sheet or your statement of financial activities, and you actually want to dig in a bit more detail about the components of those figures. Taking each of the financial statements in turn now, if we start first with the statement of financial activities, it is, as I said, the income and expenditure statement for the charity, and it's really, in essence, the equivalent of a profit and loss account in a company. If your charity is a group of charities, it has various subsidiaries, the results that you see on your sofa will be on a group or a consolidated basis. Typically, those charities that are part of a group will only show the information on a group basis. There is an exemption to allow you not to show the charity-only information, but you may do so as a secondary additional statement in your accounts. The headings I'll go through on the statement of financial activities in a minute will be based around the charity's activities. It's commonly referred to as activity-based reporting. But before we look at these headings in detail, I just wanted to show you for a few minutes a set of accounts, income and expenditure statement for a company, and what it looks like. As you will see from the company's profit and loss account, the layout is very simple. There is one line for income, one for direct costs, another one for admin costs, and so on. And you then easily arrive at the bottom line surplus or profit. Now, if you contrast this with what you would expect for a charity, this is what a typical charity's income and expenditure statement looks like. There are a lot more columns and rows of information to convey the information. So inherently, charity accounts are a lot more complex than a profit-making company's financial statements. And I'll explain to you why that additional information is really key for charities. So let's start off by taking the columnar information that's set out in the statement of financial activities. Typically, the first column that you tend to see in any charity's accounts are unrestricted funds. It is, as the name suggests, relating to funds that are free of any restrictions from donors or funders who've given monies to the charity. Therefore, those monies can be used for any purpose within your charity's objects that the trustees and management see fit. You can, from time to time, designate part of those unrestricted funds, which are funds really ring-fenced for a specific purpose. For example, the charity has plans for a future capital project or wants to invest in its IT and may decide to earmark funds for that area. This is a designation you see on the balance sheet rather than the statement of financial activities, and it can also be reversed if plans change. Ultimately, these funds are still unrestricted, albeit they are designated. The second column you have on a statement of financial activities is restricted funds. They are where the funders and donors give funds for specific purposes, so the monies are restricted in use. A good example is when a charity is raising funds for a specific appeal and donors are giving money towards that appeal, rather than the wider activities of the charity. I'm often asked with the question, what do I do with unspent restricted funds? That is, you've got to an end of an appeal, you've spent as much money as you planned to, and there's some surplus left over in those restricted funds. Can you spend them on other areas? The simple answer is no. You, in fact, need the charity funders' permission in order to be able to release those funds and be able to use them somewhere else. If this isn't easy, and often that is the case over time, you can apply to the Charity Commission, who will help you in the process of unrestricted the funds. But permission is key. Otherwise, it's ultra-virus to spend funds outside of the purpose without that permission. Moving on to the final column that you typically see in a charity's statement of financial activities, and it's titled the endowment funds column. This particular analysis is less common in charities, and you typically tend to find it in charities that are endowed charities. That is, funds have been given with certain limits on expenditure. Funds have essentially been donated to be used as capital and cannot be expensed. And there are two types of endowment funds to be aware of. One is a permanent endowment. These are more common, and essentially you cannot spend the amount given, but usually you can invest it. So any return you have on that investment, you can use for unrestricted purposes, which is how a number of grant-making charities generate their income. Funds left to them in perpetuity are invested, and then the investment income is used to make grants, but not the original donation. The other is expendable endowments. These are far less common of the two. And here you usually have a time element built into when you can spend the expenditure. So for example, you might have a donation of X million that can only be spent after, say, 5 years. So up to the 5-year period, the amount would be shown as an expendable endowment. Both these types of funds need to be shown separately on the SOFA from restricted and unrestricted funds. Now we move on to the rows in the SOFA. What is the meaning of these rows, and why are they presented in the way they are? If the columnar information represents restrictions, or rather lack of restrictions on the funds you receive, then the rows represent the diversity in a charity's activities. If we start on the income side first, you have the first heading, which is donations and legacies. And as you would expect, it would include any donations and legacies given to the charity, but it would also typically include grants given to the charity for a general purpose rather than a specific purpose. Grants given for specific purposes are treated within income from charitable activities, which I'll talk about later. The next heading you have is trading activities. Charities can also carry out trading activities as a means of generating additional income for the charity. So, for example, a charity may have a shop, it may sell services which are outside its general charitable purposes. They may also hold fundraising events or enter into sponsorship deals. And some of these activities have tax implications and often need to be channeled through the trading company. And therefore, all of that income is included within other trading activities row. Then you have income from investments. This includes dividend income, bank interest, but also if your charity has investment properties, you'll generate some rental income, and that income would be shown within this category. You then move on to the middle of the slide where you have charitable activities. And this is income that's directly linked to the main charitable activities you undertake. The income that relates to the primary purpose of your charity's existence. For example, if you're an independent school, this will be fee income for the provision of education. If you're a membership charity, it will be membership income or income you get from providing training courses, and so on. Each charity has a choice of how they label that charitable activity, i.e. the defining of X, Y, and Z on the slide. For example, you may have a homeless charity that may only choose to have one definition of an activity. For example, they may decide it's the provision of support and welfare to the homeless. Equally, you may have the same charity and the trustees and management decide that it has multiple activities, and the categories may well be helping adults, teenagers and migrants as 3 separate categories. The choice is down to the trustees and managing of those, defining of those activities. And then finally, on the income side, you'll have other income. This is in essence income that you cannot put in any of the other categories. Typically, you will tend to see, for example, the profit you generate on the sale of a fixed asset would go against here. Theoretically, as it's the balancing area, it's worth remembering that it would be unusual to see very high amounts within other income. And if you do, for your charity's account, see other income with a very high amount, it's definitely worth investigating further and looking into the notes to understand what that other income relates to. Moving on to the expenditure side, you'll observe from the slide that I've provided arrows. These arrows mirror the income side. So if you want to see how much was spent on a particular activity, you can go across to the cost category. I have presented this information on this slide on a side-by-side basis to demonstrate this point. You wouldn't typically see that in the charity's accounts. It would be income to begin with and expenditure below. Let me pick up in detail consideration of how much expenditure is spent against income. Accepting that As a not-for-profit entity, the charity is not seeking to generate surpluses unless it's looking to build up its reserves or spend monies on something in the future. But for some categories of activities, it is important to consider this. So for the first three income headings of donations and legacies, trading activities and investment income, if the costs associated with these are consistently year on year exceeding income, then as trustees and senior management, you need to be asking yourself whether you should be undertaking those activities. The purpose of these categories is really to generate funds for the charity. But if you're generating a loss, then it's your charitable activities which is in essence subsidising this relationship and not the other way around. If your trading company was set up as a means of generating revenue for your charity's main activities, but it continues to make a loss, then should the charity still continue with it is a key question. Likewise, with fundraising, initially when you start a new fundraising activity, there is a period of time before funds start to come in. But if year on year your fundraising costs exceed the income raised, then the fundraising model is really not working. So it's important to consider this when looking at charities' accounts, but perhaps not a single year in isolation, but looking at trends over a period of time. In relation to income and expenditure relating to charitable activities, I mentioned earlier this relates to the primary purpose of why the charity exists. It will include fee income, contractual income, if you have performance-related grants or you receive restricted funds for specific projects, all of this income will go under charitable activities. On the cost side, the focus should really be understanding the makeup of those costs. So costs typically include direct costs relating to that activity. The way I look at it, they're costs that wouldn't occur if the activity didn't take place. And therefore, it will include things like materials that you need to purchase for a specific project, the staff who are working on that project, and so on. A charity may also make grants. This is where you're making a grant to an individual or another charity so they can undertake their charitable activities and support their purpose. And finally, you have support costs, which are really overheads essentially that can't be allocated to one particular activity, but relate to the organisation as a whole. And these relate to costs such as your IT department, your HR team, rates and utilities you pay for the building. There will be a note in the accounts that shows how expenditure is split and bases on which support costs get allocated to different activities. Having now looked at how income and expenditure is shown in the accounts, it's important to just spend a few minutes understanding the basis for recognising the income and expenditure. At the start of the seminar, I mentioned that charities, unless you're very small, need to prepare accounts on an accruals basis. Accruals basis is very simply recording income and expenditure when it's due to the organisation rather than when the cash is received or paid. It is, in essence, the opposite of cash basis. So typically when you purchase something, a supplier will allow you 30 days for payment. The point at which you recognise the expenditure and the liability for it is actually when you purchase it rather than when you pay for it 30 days later. Similar principle applies on the income side. And for charities, there are 3 rules each for recognition of expenditure on an accruals basis and 3 rules for income recognition. Starting with expenditure, when do you recognise expenditure and a liability? Well, firstly, is there an obligation? And this really is based on either a legal obligation or a constructive obligation. A good example of a legal obligation is an organisation will employ staff. This will be on a legal contract, and at the end of the month, you're legally obliged to pay them for the services provided to the organisation. A constructive obligation would be something like a grant-making charity making an offer of a grant to an individual or a charity. You're not legally bound by that offer, but there is a constructive obligation at the point at which you communicate to a grantee. The second rule for recognising expenditure or liability is probability. How probable is the expenditure likely to occur? And the general rule of thumb is that if there is a 51% or more likelihood of having to make a payment, then you recognise it. And the final criteria is measurable. Can you put a number to the liability? And in essence, you need to have all 3. You need to have an obligation, it needs to be measurable, it needs to be probable. A good example of all 3, including probable and measurable, is a legal claim against the charity. With a legal claim, it's often difficult to assess the probability of payment or indeed the amount, and therefore you only recognise it when you can tick off each of the 3 criteria. If you're a grant-making charity, or indeed you're a charity that does some level of grant-making, there are additional rules to be mindful of. And these relate to when you communicate to a grantee and if there are conditions attached to the grant that you're making. And finally, who controls those conditions? So for example, if you communicate to a grantee and the grant is unconditional, you recognise the liability immediately. If, however, the grant has certain conditions of performance, then it depends on who controls those conditions. If you're a grant-making charity, there are additional rules to be mindful of in addition to the ones that I've just detailed above. In essence, you recognise a grant at the point at which you communicate to the grantee, but also you need to be mindful if you're putting conditions within that grant and who controls them. If you as a grant-giving charity have no control over those conditions, then you recognise that grant immediately. Say you're a charity that funds students at universities. If one of the offers that you've given, the student has to get on average 80% at the end of year one on their results, in order for them to qualify for a £5,000 grant for year two, the fact they can get 80% is outside of your control. You as a charity do not know if they're going to meet that criteria or not. And because it sits outside of your control, you recognise the liability at the point at which you communicate to them. On the income side, you have similar rules. And again, for income recognition, all three of those rules need to be met. The first rule is entitlement. Is the charity entitled to the income? Here, caution has to be exercised when it relates to conditions. So, if there are conditions to getting the funds, you only recognise that income at the point at which you've met the condition. So, for example, you have a capital project, a funder has given you the money, and the condition for that money entitlement is planning permission. The point at which you recognise the income is only once you've received the planning permission and not before. Similarly, you have to be fairly certain of the money's coming to you. And again, we use a 51% probability as a guide. If it's 51% or more, you recognise the income. And finally, can you actually put a value to it? A legacy is a good example where it can be really difficult to determine if you meet all of the above, particularly if it's a share of an estate that needs disposal. So there's a time element and there's an element of uncertainty in terms of the value that you'd be entitled to. Having looked at income and expenditure, we now turn to the financial position and the balance sheet. This captures the total funds, the reserves position of the charity at its year-end date by categorising it into assets and liabilities. And I'll go through each of the key headings that you typically see in a set of charities' balance sheets. To begin with, you have the tangible fixed assets, and this really relates to expenditure that you've incurred that will be used over more than 1 year. The way I see it, it's a multiple use category. It's really things such as buildings that the charity may own or have on a long lease. It will be things like computer equipment, fixtures, fittings, motor vehicles, and so on. And the way the cost is actually recognised in the accounts is you try and spread the cost over the life of the asset, and you do this through the depreciation charge. So for example, most charities write off computer equipment by over 3 years. So in the first year of purchasing the asset, you capitalise it, but over 3 years, you write it off as depreciation in the SOFA. The other category is investments. And many charities hold investments as a means of generating additional income. This may be things such as listed investments, shares, etc., but it can also include things like investment properties. Regardless of the type of investments, all investments are held on the balance sheet at their fair value, which in its simplest form is the open market valuation. For investments, it's relatively easy to obtain this, and all investment managers will issue a year-end investment report to the charity. But for investment properties, this can be more tricky, and you will have to commission a property valuer to get that report. We have noted some examples of current assets, which are assets either already in cash form or expected to be converted into cash within the short term. This will include things such as stocks that you trade with, but also debtors, which are monies owed to you. These items are shown as assets in the balance sheet, and they're funds which the charity owns or is owed. Now we have liabilities. This includes balances which are monies owed by the charity to another party. Usually within short-term liabilities, that's creditors less than 1 year, it will be payments that are due to your suppliers. Also accruals, whereby you're estimating costs such as utilities, for example, or rent. You'll also include things such as the amounts due on HMRC payroll at the end of each month and VAT. You may also have balances whereby you've actually received income which is in advance relating to next year. but where the 3 points for criteria for income recognition haven't been met. So it's held in the balance sheet until that recognition criteria has been met, and you'll see this as deferred income within creditors. Creditors more than 1 year or longer term liabilities will include balances, as the title suggests, that are due after 1 year. And if you have a bank loan, for example, the balances that are repayable in more than 1 year will be within this category. And then finally, for some charities, but not all, charities that have defined benefit or salary sacrifice pension schemes, you'll see a liability in there. And the liability is actually attained from the actuaries. And there's one thing just to be mindful of, is that not all pension liabilities that relate to defined benefit schemes can be quantified, or quantified in relation to your organisation. Typically for schools and colleges, teachers' pension liabilities can't be quantified for the organisation, so they're not measured on the balance sheet, but local government pension schemes are. This is a fairly complex area. For the purposes of this presentation, I think it's about as much as I want to say, but it's certainly a key area to look out for, and the detail that you see in the notes to the accounts if your charity does have a pension liability. Next, we move on to the notes to the accounts. These includes much more information on the charity's finances than you would see on the statement of financial activities or the balance sheet. I won't go through every note, but I just wanted to pick out some key notes which are important for charities. The staff cost note is important for any organisation, but for charities there's an additional requirement to show number of staff who are paid on a higher bracket, which in the charity sector is deemed any staff who are paid more than £60,000. And they go in the bandings of 60 to 70, 70 to 80, and so on. This is a particularly sensitive area, and it's really important that you have to be happy that this disclosure for your charity is appropriate and correct. For similar reasons, related parties disclosure is also very sensitive. Related parties are really transactions, typically transactions with charity trustees and their relatives. So if a charity undertakes a transaction with a trustee, they would need to disclose both the quantum but also the nature of that relationship. Given it's a key area of disclosure, it's worth ensuring before the accounts are finalised that the information is correct. You may also see in your charity's accounts a section on contingent liabilities. These are not common, and therefore they're key if you do see them in your charity's accounts to look into more detail. These are really liabilities that haven't yet been recognised because the recognition criteria for liability, the 3 areas that I talked about earlier, hasn't been met. But it relates to something that if those conditions are met, the liability could be quite significant. And it's important to understand, if you do have any contingent liabilities, what it relates to and what the charity accounts are saying about those. And then the final area is operating lease commitments. Typically for charities, this may not be significant, but for some charities, particularly if they have a lot of assets that they lease, it's an important note for consideration. With lease agreements, there's a commitment to pay over a certain number of years, but you only recognise the cost on an annual basis. And if you have significant lease commitments, whilst you may not recognise future commitments in this year's accounts, it is worth considering this and the impact financially for your organisation, particularly if cash flow is a significant concern for the charity. The last thing I wanted to end on was the deadlines. These deadlines are important. If you're a charity, you're required to submit your accounts 9 months after the financial year end to Companies House and the Scottish regulator, OSCR, and that deadline extends to 10 months with the Charity Commission. This is where I want to end my section, hopefully having provided a big picture overview of charity accounts.